Hello everyone. Today we are going to look at a manufacturing business income statement. We know that a merchandising business and a service giving business organization's income statement is quite different from manufacturing business income statement. At the end of this video, you will have a deep understanding and you will know everything about this topic. So let's begin. First of all, note that this is only a simplified version of income statement and it doesn't contain all of the components of income statement. I just took some of the income statement components just to simplify the concept. In order to know how the income statement of these three organizations differ, we need to know how they differ each other before. First of all, what is a merchandising business organization? A business organization of merchandising business is operates by buying goods and by selling that goods. A manufacturing business organizations will buy a raw material and will turn that raw material into finished goods, and this finished goods will be sold. In either way, there is something called goods. However, in service giving business organizations, there is nothing called goods. A service giving company might buy goods, but not for the purpose of operation or to sell them. If it does, it will be called as a merchandising business. But service giving company will render service and get its revenue using that. Now, if we know about these three organization service, so we have to know what an income statement is. An income statement is something that shows how the company was operating for some period of time. For example, from 2011 to 2012. And within this time range, the company might operate and have a loss or a gain, and an income statement will detect that. So, what do you think will determine a profit or determine a profit or a loss? First of all, if the company is earning more, it's becoming profitable or the profit is increasing. And if the company is spending more, its decrease its profits and loss will occur. And this is what will be shown in profit or loss statement. So that the earning will be represented by something called a revenue, and the spending is represented by something called an expense. And the difference between these two is known as an income. Good. Now we know about what an income statement is. It detects from specific time range what were all the revenues within this time range, what was all the expense within this time range, and the difference will be shown as a profit or loss in the income statement at this time. Or the income statement will be prepared at this time, however, it will show all the profitability or loss or how the company was operating for the past time until this point or within this range of time. Good. Okay, now if you know what is an income statement and what these companies do, so we have it's time now to look at how the income statement of this company should be. Let me start by discussing about income statement for service giving company. We know that a service giving company will render service, and from that service it will collect a revenue. that's called revenue. To render that service, it should expense some money or some resource that is known as the resource spent is known as an operating expense or expense. And the difference between these two is called income. And this income expresses the profitability of the company for some period of time will be shown us on the income statement of this service giving company. And now let me go to the manufacturing and merchandising one. Let me continue with a merchandising business organization. As we all know, a merchandising business organization will have also a revenue, and this revenue will come from selling those goods that he has purchased. And there is something called a cost of goods sold. This is the basic difference between service giving and merchandising one. Because as you have seen in service giving, there is a revenue and there is operating expense. There is no cost of goods sold because there is no good here. We have seen that. So there is no cost of goods sold too. Cost of goods sold is the money that is spent to on the product that is sold. Here there is no product that is sold. It's only service given. So that cost of goods sold is not recognized here. So here there is cost revenue, cost of goods sold, and there is operating expense. Just there are any other expense which are not spent on the goods that is sold, but for the operation we might incur some expense. This expense is expressed in the form of operating expense. The difference between these two expenses and this one revenue is called an income. So an income statement for merchandising business should contain this format. Now let me go to a manufacturing business organization. Here also, the same with merchandising business, there is something called revenue. There is something called a cost of goods sold. In manufacturing business, we buy raw materials and we will further process and make it finished good. And this finished goods will be sold and bring some revenue. So the money that we spend for this raw material and to change this raw material into this finished good and to sell this into this finished good, sorry, this is called a cost of goods sold, because if we sell that product, we have incurred a raw material for this product, we have incurred some costs to further process and make it to finished good. That will be known as a cost of goods sold. And in order to sell this product and to maintain the operation, we can incur another expenses. These are called an operating expense. And when you deduct it from the revenue we can get the income. Now we know that a service giving business organization will not contain something called a cost of goods sold. We know that a service giving company might also incur some cost buying some product, but that product will be bought not to sell that product, rather okay. So any cost that is incurred to produce this finished good, or only any cost that is incurred on this finished good, is known as cost of goods sold. But it became a cost of goods sold when this finished goods sold. Otherwise, it is not cost of goods sold. However, it is cost of goods manufactured. Okay, so here also we have revenue and cost of goods sold. We know that after this good is prepared, or there might be any other costs or expenses that are used not to produce this finished good and make it ready for sale, but not for that, but there might be any other reasons that might uh, we expense or spend to operate the business that are called operating expense here, operating expense. So now also when we deduct these two expenses from this revenue, we will get an income. Please note that I don't mean that all income statements are the same, but the main content of income statement of manufacturing company is this one. There might be any other things so. But let me ask you one question. Why don't we have cost of goods sold here? Does it mean we will not incur any cost on some goods or we don't have goods? It doesn't mean that. We might have goods here also, but those goods are not bought for sale. Those goods are not bought for selling purpose in the service giving case. For example, let me think one school. A school might buy uh, chairs, blackboard, any other goods, you know. So that organization will not sell those goods. So that goods will not result in cost of goods sold. If he sells them, it is not a service giving company anymore. It is okay. From this, we have noticed that an income statement of service giving company mostly has revenue, operating expense, and income. Uh, it doesn't usually have a cost of goods sold. So we have noticed the difference with this one. So we have finished that because in merchandising and manufacturing business organizations, it is usual to look at a cost of goods sold. However, here it's not usual to look at cost of goods sold. This is the main difference with the service giving one because their main operation doesn't contain that much goods. So what we haven't clearly seen is the difference of merchandising and manufacturing income statement. For merchandising one, we have revenue, cost of goods sold, operating expense, and income. These are the main elements. I don't mean that this is the only elements of the income statement, but there might be others too. But these are the the main elements of the income statement. We might notice any other elements. Here also there is a revenue, cost of goods sold, and operating expense and income. Here also there might be any other elements of the income statement. For example, there is cost of goods manufactured, which is present in the manufacturing organization's income statement. However, that does not include it in the in merchandising one. So there might be any other elements, but these are the main elements one: revenue, cost of goods sold, operating expense, and income. So as we have seen from this, we do not observe that much difference of on the merchandising and manufacturing income statement. So we should look at deeply what the difference between these two organizations' income statement is. So first of all, let's start our discussion by looking how these two organizations treat their inventories. That will give us a biggest understanding on how these two income statements will differ. To understand this difference from the beginning, we have to know how these two different companies treat their inventories. First of all, what is an inventory? An inventory is something something that is it might be both like in the merchandising case or it might be prepared in the form of finished goods like in manufacturing companies. So we hold that inventory to sell only for selling purpose. If we hold that good for selling purpose, whether we produce, so if you hold goods just to sell it, and your business operation, your main business operation is based on selling that, whether we produce, manufacture it, or whether we bought it from some from elsewhere, that good is called an inventory. Now let's look at how an inventory is named in these two different companies. An inventory is named in manufacturing company, it's called unit produced or finished goods, because this company will produce this inventory. For merchandising company, it is known as purchase, because they will buy and sell it. Now let's start by looking at this purchase for merchandising company. In the past year or in the previous year, there might be some inventories that are left. These are called ending inventory. And this ending inventory, when they come to this new year, they are called a beginning inventory. So with this beginning inventory, we might add or purchase some more inventories. These are called purchase. So this one is a beginning inventory, this one is a purchase. Now let me eliminate this thing, because this express all amount of beginning inventories and purchase. So this is the total inventory we have, which is the addition of beginning inventory until this and purchase above this point. Okay. Now from this total inventory that we have in this year, let's say this much of it are sold and this much of it are left. The sold one is called a cost of goods sold, and the remaining one is called an ending inventory. And this ending inventory will use as a beginning balance of inventory for the next year. So from this, we will draw a very good conclusion about everything. We understand what we have sold and remain what remain in our store or ending inventory. Their value is equal to what they came from the previous year, which are called the beginning inventory, and what we purchased this year. So from this we can say purchase plus beginning inventory is equals to cost of goods sold plus ending inventory. This is a very good relationship. So what do you think the total value of these two is? I mean, what do you think purchase and beginning inventories, when we add them, what do we get? So what will the aggregate result of this will tell us? What will the aggregate result of this will tell us? Let us look at logically. We know that when we have a beginning balance of inventory that came from the previous year, and when we buy another additional purchase of inventory, that will tell us we have planned to sell or we made available this much of goods for the selling purpose. So it gets the same, or the addition of these two is called cost of goods available for sale. That's why. So how about the aggregate balance of this? We know that we sold from this plan, we have sold this much of it, and this much of it remain in store. It means that this will tell us we made ready this much of goods to sell. So, but this much of it are sold, and this much of it are sold, and this much of it are not. So that the balance or the addition of these two will also tell us what were our plan to sell or what we made ready to sell. This is also cost of goods available for sale. So cost of goods sold plus ending inventory will give us cost of goods available for sale. The same way, purchase and beginning inventories aggregate balance will give us cost of goods available for sale. But here we have a lots of inventories that are ready to sell. So why do we call this cost of goods available for sale? Why don't we simply say these are goods available for sale? Why don't you simply call this? Because in accounting, everything is recorded in its value of its monetary cost. What do you mean by that? For example, if I have a t-shirt, in income statement, I will not record something called t-shirt. Rather, I will assign a dollar amount for this t-shirt, and that cost or dollar amount is recorded in the income statement. So that's why we have said that the value of this all inventories dollar amount will be calculated and recognized as the cost of goods available for sale. Or we will record the cost that we incur to make these goods available for sale. So, in the case of manufacturing company, what will you do if you have asked how much cost you have incurred this year to buy your inventories? Or if we know how much you have sold, how much remain in the store, you can simply know how much were available for sale. From that, if you know the beginning balance of your inventory at the starting point, you can know how much you have purchased this year. So simply, you can know purchase is equals to cost of goods sold plus ending inventory minus beginning inventory. So when we deduct this, we can get the purchase amount. It is very simple to know the purchase amount or the purchase dollar amount in the case of merchandising company. But how about in the case of manufacturing company? We have seen for merchandising company right now. It's very easy. You might even not need all these calculations. If we know how much you bought this food, in what dollar amount you bought this good in the market, you can simply tell the purchase amount of that inventory. But how about when you produce it rather than buying it in the market like merchandising company? When you produce that good, do you know the cost of that good really? Because it needs an overhead, manufacturing overhead, direct material, raw material, direct labor. There are a lot of things that are difficult to assign these costs into this inventory. So it might not be easy to determine the purchase amount in the case of manufacturing company, just as the merchandising. So we will look at in the next part, and at least I need 50 likes to continue to the next part to do the next part. Because so we will see that in the next part. For the next part, I need only 30 likes. Please like it. So the next part will be released soon, but I need 30 likes to go to the next part, to proceed to the next part. Okay, so we will look at that. So we will look that in the next part. So for me to make the next part, I need 30 likes only. 30 likes. If I get 30 likes, I will. So we will look that in the next part. For me to make the next part, I need only 30 likes. If I got 30 likes, I'm going to make the next video. So that will be our next part discussion. For me to make the next part, I need 30 likes, only 30 likes. If I go 30 likes,